Bull and bear traps. What are they, and why they are considered to be one of the best setups for many experienced? If you are not familiar with traps and how to trade them, then you are missing out on one of the best scalping entries available in the market. To describe them in short, traps are nothing but failed second entries. But before delving into them, we have to understand what are second entries and two-legged pullbacks. A two-legged pullback is a pattern that looks like this. One leg up, one leg down, and another leg up. It's essentially the second attempt of the market to move higher. The market likes to move in twos because traders and institutions feel much more comfortable entering trades after the market makes two attempts to do something. Two-legged pullback in a 2000 tick chart. First entry, second entry. Another example of a two-legged pullback, one leg up, one leg down, another leg down, and another leg up. Only this time, the second leg up will fail. This is a trap. When a second entry fails, many inexperienced traders are caught on the wrong side of the market, hence the name trap. What occurs with this trap is that many novice traders will enter a trade at the same location, which is usually a tick above or below a previous bar or key price level. However, they are wrong. Just upon ticking higher or lower, the market will instantly reverse, trapping those traders who enter on the tick higher or lower, and they are on the wrong side of the market. The very second these trap traders realize that they have been fooled, they begin exiting on the break of the previous bar. These exits adds fuel to the move, and very quickly the market will move forward for a couple of points or sometimes even more. When you see a trap setting up, you want to have a market stop order in place exactly where the trap traders will be exiting. As soon as these trap traders all begin to exit, your order will be executed and you will be swept into the trade with the existing orders, and the move will generally be swift. In general, these setups will occur as a failed break above or below some price level by only a tick or two. The exit orders will usually be within a few ticks of the low of that bar, and that is exactly where you want to have your entry stop order. These trades often move very fast, so you need to have your order in place very early, anticipating the possible trap. You don't want to use any limit order in traps because you might find yourself not getting filled, as the move can be sharp and aggressive. If the trap does not occur, simply cancel your order. By having it in place ahead of time, you are sure that you don't get left behind when prices move. Remember, price moves like attempting things twice before giving up. Whenever the market tries to do something twice but fails, it will usually succeed in doing the opposite. Think about it for a second. When the market tries 2 times to tick higher but fails, many traders who went long immediately realize they are wrong, and there is only one thing they can do to stop the bleeding. They must bail out, and all you are trying to do is join them on the opposite direction. That brings me to a very important aspect of traps: context. You want to take them only in the direction of the overall trend. Don't just take traps because they show up on your chart. They tend to happen many times every day, and unless they are obvious, just don't take them as a standalone patterns. If you have an uptrend, you want to take failed second entry short traps in the direction of the overall trend. Traps are super effective if you take them in the right location. So always trade with the trend and take them only in the direction of the overall buy. You don't want to be this trader who goes against the overall trend.